Hey there, this is Bobby from Payitoff here to give you a quick demo of the income-driven repayment comparison tool that we just released today. So there are a lot of federal income-driven repayment options out there. Sometimes it makes sense for certain clients and sometimes it doesn't. And what we're going to walk through is an example of how we could compare normal prepayment or refinancing against some of these income-driven repayment plans that the federal government provides. So the first thing to do to find out whether a client's eligible for these types of programs is to add a little more information about them. One of those things is filing status, their residence, whether they're on the mainland or not, and what their gross income is. This is something that can be found on last year's tax return, as well as their spouse's income and family size. The new borrower date down here is when the client was first disbursed a direct or FFELP loan, so any federal loan. They should not have had any balance on any federal loan prior to this date. Also, there's the public service loan forgiveness qualification step here. So if your client has an employer who's a nonprofit or government organization, they may qualify for what's called public service loan forgiveness, which means after 120 qualifying payments that the debt forgiven won't be taxed. So this can actually lead to the most savings if it applies to your client's situation. Say they work at a nonprofit hospital. And it's interesting if they're deciding whether to go nonprofit or for-profit to make this comparison and see what the effect could have on their financial outcome. We've made it simpler to figure out whether their employer is eligible by just searching here. So say that they were starting to work at a hospital, Corning Hospital does apply, and then immediately this will update as a qualified PSLF candidate. We'll come back to this. We'll do it without PSLF right now, but we'll come back and look at the comparison between the two. All right, so now that our client's been updated with that information, let's look at Amanda's loans. So Amanda has direct loans for the most part, and there's a mixture of unsubsidized and subsidized loans. With our income-based repayment or income-driven repayment comparison, we're accounting for any of the subsidization preferences in all of the plans. So we've actually seen on the right here that there's a few of the repayment options that the loans and the borrower are eligible for. So we can enable that IDR comparison here. And when we generate a report, what we'll see if we scroll down past some of the prepayment and balance over time stuff is this IDR comparison matrix. And what this is estimated projections on how the federal programs could affect the repayment process. So in this situation, we can see how each of these programs would shake out if they were to start repayment today. So if you have a client who's in progress with an IDR plan, we're going to release a way for you to input those loans as well. But for now, we're assuming that this the client is actually entering repayment now or considering one of these programs. So the first one, we have income-based. Because of the date that the borrower started getting loans from the government, they qualify for the 2009 income-based program. And that program actually has a 15% of your discretionary income as opposed to 10% of the monthly payments. So actually the total paid ends up being a lot. So this might not be the most attractive option. However, they're out of debt 3 years sooner, so there is some benefit to that time and to freeing up that cash flow. Also, there's with the repay versus pay plan, so revised pay-as-you-earn and pay-as-you-earn, they're actually paying the same amount. But the forgiven amount is different because the repay plan has much more generous subsidizing behavior. So unsubsidized loans, any unpaid interest will actually, if the monthly payment doesn't cover it, the unpaid interest, the government will cover half of that if they're unsubsidized. So there's no other plan where they offer interest subsidies for unsubsidized loans except this one. So sometimes that makes sense because in this case it saves the client about $2,000 once they have to pay taxes on that forgiven amount. So there are interesting conversations to be had here around whether this makes sense at all or whether it's something that is attractive for your clients. There are also some assumptions here that we basically make And we want to start being able to forecast these better, but for now we have some base assumptions. For instance, income rising 5% each year, family size is remaining the same for the life of the loans. We use a historical average for the poverty guidelines. So we looked at the last 20 years of how the poverty line increased and used that to forecast. And we also assume that current interest rates won't change, but that's not always true because there are definitely variable interest rates that will affect the total paid amount. So let's go back and check out the PSLF version of this. So if we go back to Amanda's page and edit here, we can enable this and go back once we've updated. And in this report, you'll actually see that this has been updated to show exactly how this would shake out with a PSLF qualifying payment, or 120 qualifying payments. So in this scenario, it's very similar in the sense that repay and pay, there's really no reason to go for one or the other. In this scenario, it might make sense to actually stay and pay because pay has caps on interest capitalization, so it can only be 10% of the total of the original balance. So that's actually a healthy option because the term is 10 years, and if anything changes, say they need to jump out of the plan, you don't want to be stuck with a ton of interest. So a lot of this just is about understanding some of the nuances of these plans. So the tools we'll be introducing in the coming weeks is ways to drill down on the specific trade-offs for each of these. For now, we're showing you the macro view, and we want to dive in on more of the details in the next coming weeks. So we hope this is a helpful tool. And please give us feedback. We'd love to know what you think about it. Thanks so much.